Welcome everybody to Safe Option Strategies presentation of more technical chart reading. This class is a production of Safe Option Strategies and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk and you are solely responsible for any losses you may incur as a result of trading. All right, so if you're watching classes in order, or if you were here with us live when we did the previous class, just by way of a quick review, we talked about the three big indicators. We talked about the reason we watch the RSI, the 5 and 20-day exponential moving averages, and the MACD as the primary three indicators for when we are getting a trend change. We mentioned that a trend change is when the direction of the stock changes for more than a couple of percent or more than a couple of weeks. We don't consider a one or 2 day change in the stock price to be a trend change. Any movement on any day could be the beginning of a trend change, but we consider ourselves moving into a trend change more often than not when we get those three technical crossovers. And we also talked about the importance of volume, the importance of support levels and resistance levels. And then if you back up a couple of classes to fundamental analysis, you start to put together a complete picture. What I want to focus on in this presentation, in this class, is first of all, setting up your charts. I'm asked all the time by people, all the screenshots we use for the different classes, for the different strategies that we do, screenshots that we use in the newsletters that go out, in the alerts that go out. A lot of people ask, how do you set up your charts, or they want to set up their charts to mirror mine. We'll take a few minutes and teach you how to set up those charts. Then we're going to talk about some other moving averages that are important to keep an eye on and to look at from time to time. I'm going to talk a little bit about Bollinger Bands. It's one of only a few technical indicators that are kind of unique and kind of different that I sometimes use. We'll talk about other technical indicators and the importance of those, but I'm also going to talk a little bit about the importance of not getting bogged down with too many technical indicators. And then we're just going to make mention briefly, because we have entire classes devoted to them, we're going to make mention briefly a little bit about sentiment analysis and earnings. They respectively have their own classes that are coming up in the schedule, so we won't spend much time with those. Let's talk about setting up your charts for just a moment. I am a big fan of stockcharts.com. I love to use stockcharts.com. It is a free website. Stockcharts.com has a paid-for section to it that I don't use. In my opinion, there is no need to use the paid membership to stockcharts.com. Everything I put in there, everything I do with it, I do free of charge. I'm going to move through this quickly. If you need some help in setting up your charts and setting it up to look the same way my charts look, just go back and review the recording of this class. I think that'll be the easiest way for you to do that. So I'm going to move through this kind of fast. If you go to stockcharts.com, you start out right here by entering any ticker symbol that you want to enter, and where it says right up here, create a chart, leave this on Snapchart. There are some other choices that you could change that one to, but leave that on Snapchart. Just type in a ticker symbol and click the go button. We've used Boeing for everything that we're doing, and I left some screenshots in here from a couple years back when we did this, but it all works exactly the same. So here's what you're going to do. On the left side of the screen, this is what stock charts is going to look like when you first put in that ticker symbol and hit go. And this is what we want it to look like if you want yours to mirror mine. All you're going to do is down below the charts, you're going to go through these items that I'm circling, and you're going to change them to what I've got over here. So the predefined range, you're going to click this down and drop this menu down, and you're going to change it to a predefined range of 6 months. You don't have to drop down either of these menus right here. These will automatically fill in. I like to put in 15 or 20 extra bars. That's just the space I have out here to the right of today's date. So we're going to drop this menu down. We're going to change that to 6 months. We're going to type in 20 right here. Moving along, I like to change this from candlesticks to OHLC bars. That's my preference. I like the color scheme to be blue-gray. And one thing I left out of here on the size, depending on the size of your screen, experiment with some different sizes. I go to the landscape view. That fills my screen with the biggest view I can get. You can do that one to whatever your preference is. That's not a big deal. That's why I don't have it circled. I like the blue-gray look. That's up to you. I turn off the y-axis labels because if I leave that turned on, so I uncheck this box, if I leave that turned on, then I get a whole bunch of information over here that covers up the prices. So that's why I turn that off. So I uncheck that box. Now, the default when you go here is simple moving averages. We're going to talk about simple moving averages later on in this presentation. I changed these simple moving averages to exponential moving averages, and I want the 5 and the 20-day exponential moving averages. So I drop this menu down right here. I click this little arrow and drop this menu down. I change it to moving average exponential, and then I type in the number 5 right here. I type in the number 20 right here. Okay, get both of those set. You should not have to do anything with this. When you get down here to these indicators, the RSI and the MACD are the default indicators, and I don't do anything to change those. Now, once all of that is done, whether you use the button right here that says update, whether you use the button right here that says update, whether you use the button at the top of the screen that says update, it doesn't matter. If you click on that button that says update, on any one of those 3 buttons that say update, it's going to change and everything will look like this screen right here. Okay, the color scheme is just the easiest one for me. If you want to play with different color schemes, by all means, someone just asked a question, someone just typed in a question, is the blue-gray color scheme necessary? I like the blue-gray color scheme because it kind of matches the company colors that I use for safe option strategies. But I also like, there's a good contrast between the buy and sell volume down here. The color contrast between the buy and sell days here is really easy to see. These are just colors that stand out really good to me. You don't have to use that same color scheme. That's why I used blue-gray. It's my favorite of the ones that are available. There's a lot of different color schemes available. Okay, now very important, once you have done all of this, I'm going to clear off some of my extra marks on here. Once you've done all this, you've got this link down here at the bottom of your chart that says linkable version. Okay, let me show you the importance of linkable version. If you go through all the trouble of setting up all these different parameters, change this to OHLC bars, change this to 6 months, add 20 bars here, change these to exponential moving averages. If you do all of that and you don't click this button down here, every time you log out of this page for stockcharts.com and you come back to it, you're going to have to go through this whole process again. If you change that linkable version, this is what Stock Charts is going to look like in your, this is your URL. This is your web address, and this is what it will look like before you click on linkable version. After you click on linkable version, this is what it's going to look like. You're going to get this big, long string of information. There's your ticker symbol. There's your 6 month. There's a whole bunch of other information that goes out here. And don't worry about the ticker symbol, because once you have this set in place, you can go back here and put any ticker symbol in here, click on update, and all of this will be preset the way you want it. Once you've got this long URL in your address bar, once you've got this big long URL, then you bookmark the page. And if you'll bookmark the page, and I've got my little bookmark right there for stockcharts.com, if you'll bookmark that page after you've got all this information in it this way, every time you come back to Stock Charts by clicking on your bookmark, all of this will be set up the way you want it set up, and all you've got to do is click in the ticker symbol that you want. So don't worry about what ticker symbol you used to originally set the chart up with. Everything becomes super easy after that. Okay? So we've got your stock charts set up the way you want them now. And now as you're looking at things that I send out, as you're following through classes that we do with the strategies and so forth, what you're looking at is going to be the same as what I'm looking at and what I'm using. Easy, super easy. And like I said, if you want to go back, if you're with me live right now, then obviously you've got to wait until this is recorded, and then you can go back and you can look at it again. If you're watching this as a recording and you haven't got that all figured out yet, back it up, hit your rewind button and back it up a little bit and go through that again. All right, let's talk about other moving averages, specifically the 50 and the 200-day simple moving average. Now, I explained in the previous class why we prefer to use the 5 and 20-day exponential moving averages for our look at whether a trend is changing or not. The main reason we do it that way is that's what most people are looking at. That's what most investors are following as an indicator. And we ended the previous class talking about how it becomes a self-fulfilling prophecy. The 50 and the 200-day simple moving averages, oftentimes one or both of these are going to coincide with your next strong level of support and resistance. Sometimes when you're looking at a level of support and resistance and you don't see, you're having a hard time. You're looking at the stock chart the way we set it up, and you're saying, well, gosh, I could make a case that support is right here at 50, but maybe the stronger support is down there at 54 and a half. And oftentimes that 50 cents is not going to make a big difference, but sometimes you're looking and there's some little anomalies with the stock price breaking above resistance temporarily or breaking below support temporarily, and it's not as easy to spot where you would draw that horizontal line as your clear level of support or resistance. A lot of times, not in every case, but a lot of times, your 200-day moving average or your 50-day simple moving average are going to coincide with those levels of support and resistance. It should not be any shock that when you look up here at what the longer term resistance is, that it matches pretty close to where the 200-day moving average is currently at. That is not an uncommon thing, and that helps you define a little bit more clearly where your levels of support and resistance are. When a stock is breaking through an existing level of support or resistance, one way or the other, when it starts to break through and you see this gap here and you don't want to go back in time 2 or 3 years, take a look at the 200-day moving average, and a lot of times you're going to see that moving very close to what is the most definable level of support or resistance. And a lot of times it'll be the 50-day moving average. And the reason, so someone asked the question, a question just came in, why do you look at simple moving average on the 50 and the 200-day, but you use exponential moving average on the 5 and the 20-day? Primarily because the 5 and the 20-day are much shorter term to begin with. So we want them weighted a little bit more toward the most recent data. That's one of the main reasons. The other reason is when you've got 200 days worth of data that is giving you this indicator right here, there's no need to make it exponential. You've got so much data there with a simple moving, so much data there in a 200-day. Let me say this the right way. You've got so much information in a 200-day moving average. Whether you use exponential and weight it a little bit more towards the most recent data, or use the simple data where it doesn't weight it different, it doesn't matter. But the simple moving average is going to come closer to coinciding with those levels of support or resistance. So when we're analyzing a company, when we've had a level of support or resistance that's recently been broken through, it's a good idea to take a look at that 50-day simple moving average and that 200-day simple moving average and get an idea of where that next level of support is or where that next level of resistance is and where it might be a little bit longer term. So these are some other moving averages that we sometimes use. Now, Bollinger Bands, I'm going to confess to you, I don't use Bollinger Bands a lot, but when I am considering, there's several different trades where I will use Bollinger Bands. If I'm considering an iron condor, if I'm considering a butterfly spread of any kind, or if I am considering a very short-term trade, Bollinger Bands can sometimes predict when a strong breakout is going to happen. When you use Bollinger Bands, it's interesting that we were just talking about, well, let me say this, it's no coincidence that we were just talking about support and resistance levels. When you look at Bollinger Bands as a technical indicator, keep a very close eye on that next level of resistance or that next level of support. The idea behind Bollinger Bands is that when you get a contraction like this in the Bollinger Bands, so the Bollinger Bands are made up of some moving averages or some envelopes of averages that the stock trades within. When you get a tightening of these Bollinger Bands, when you get a constriction of Bollinger Bands like this, oftentimes within a couple of trading days to maybe a week later, it's an indicator that a strong breakout is likely to occur. It's never going to predict which direction. It's never going to predict how far. It's just one more indicator that you could be due for a strong breakout. And the longer and the more narrow a channel like this becomes, the greater the chances are that you get this breakout one way or the other. Now, I like, when I'm doing a straddle or a strangle, I like to see, am I currently in a constricting pattern with these Bollinger Bands? Or have I been in a channel that is getting narrower, more and more narrow, as I'm giving consideration to a straddle or a strangle trade? I'm going to look at it with iron condors as well, because I want the stock to stay in a range for a longer period of time. And if I've got a strong constriction on these Bollinger Bands, I may not be wanting to or willing to place that trade. Again, it's one more indicator to maybe help you make a decision if everything else you're looking at ahead of this is not already convincing you that it's a good or bad trade. Take a look at Bollinger Bands. Okay, now when you're looking at Bollinger Bands, I mentioned this in the bullet points, even when you're getting a constriction on Bollinger Bands, or you've spent a fair amount of time inside a channel like this, look at where your strong support or your strong resistance is, because even tightening of Bollinger Bands doesn't mean that the next breakout is going to be able to push you outside the envelope or outside of your most recent support or resistance levels. So you've got to take that into consideration. You have to keep that in mind and recognize and know that the Bollinger Bands are not going to be any kind of a guarantee that the push you get is going to be sufficient to get you past that next level of support or resistance. So the reason I mention this is you want to be cautious in using Bollinger Bands. Don't assume that a real tight constriction in the Bollinger Bands is going to lead to this type of a breakout every single time. Use it as one more piece of information to help you paint a more complete picture. Now, I want to talk a little bit about some of the danger in technical analysis. And you're going to have to bear with me while I share some I'm not going to say personal stories. I'm not going to share a lot of stories, but it's a common thing when a new student comes to Safe Option Strategies who has had previous training from other companies, and then sometimes that training is very good and sometimes that training can be very detrimental. I don't make it a habit to badmouth my competitors, so I'm not going to tell you who you're getting good information from or who you're getting bad information. But something that I have found in common with a lot of other investment education companies is an over-focus on technical analysis. Now, let me clarify what I mean by that. Technical analysis is incredibly important if you don't cross the line of over-analyzing something. When we're setting up those charts, if you back up to where we were setting up those charts, take a look at just a handful. Whoops! Let me circle. I thought I had the automatic circles come in. I'll do these ones by hand. Take a look at. We were just talking about Bollinger Bands, and earlier we set our charts to the exponential moving average. We've got parabolic SAR, chandelier exits, pivot points, price channels, VWAP, zigzag retrace. This is just a small sampling a small sampling of all the different technical indicators you could use. This is one of my favorites, an Ikimoku cloud. This has got to be one of my absolute favorites. An Ikimoku cloud. How many people do you know that use an Ikimoku cloud? This is a rhetorical question. How many people do you know that use that as part of their technical analysis? Obviously, someone is using it somewhere, and someone somewhere probably thinks that that's a fantastic economic indicator, and it may be. My purpose is not to tell you that using an Ikimoku cloud is a bad thing, but here's what people often, I have this conversation with so many people that are new to our program, it would absolutely stun you. I get people who literally get analysis paralysis. That's not my term. You've heard that in other places. That's not my term. Other people use that term. If you start looking at too many different indicators, they're never going to align, or the odds are that they're rarely going to align in a way that's going to cause you to take action. You're always going to have some indicators that have the ability of contradicting your other indicators, or they're not lining up the way you want them to. And it is so easy to get bogged down in too many technical indicators and get paralyzed and not make a move at all. I'll share one story with you. This goes back probably 8 or 9 years ago. I had a student that joined the program, and for the first several months they were in the program, I would get an email from them almost every day asking me, have I looked at a certain technical indicator? And it was a different technical indicator every single time. Every time it was something different. Have you looked at this, and what are your thoughts on this, and why this is, why are things moving outside this Keltner channel right now? I'm being hypothetical on what she actually said. Why aren't you looking at this a little bit closer, and why didn't you look at this so that you wouldn't make this move? And this person's intentions were good. They weren't, I never felt threatened, like they were questioning me in a negative way. I never felt like they were, getting on my case for doing something wrong. They were genuinely, very genuinely wanting to learn and wanting to get better at everything they were doing. And that's great. So I had no problem with that. I didn't, hopefully I never made them feel bad for any of the questions they were asking me. But it seemed like almost daily it was another question about another indicator. And finally I said to them, have you placed any, I'm technically not supposed to do this, but I said, have you placed any trades at all since you started the program? Have you followed any of the trades that we've done? Are you in any open trades right now? And the reality was they hadn't made a single move since they had joined the program. This was 2-3 months into the program. They had not made one single move on any trade that we had placed. And a lot of it was because nothing had lined up correctly for them. They were waiting for dozens of stars to line up in exactly the perfect pattern before they were going to make a move. As a result, they never moved at all. The thing I want to leave you with when it comes to technical analysis is be careful that you're not over analyzing things. Okay, I'll leave one last little anecdote with you. I've got 4 kids. My girls have very similar personalities to each other. My boys have very similar personalities to each other. And in some ways, they are polar opposites. My girls are a little too spontaneous, a little too fly by the seat of your pants at times. On the flip side of that, my boys overanalyze everything. It's hard for them to be spontaneous. It's hard for them to, I'm not going to tell you they don't go out and have fun. They almost have to rely on their sisters to set it up. When they're going to get together with friends and do things with friends, they kind of have to rely on other people setting it up. My girls can start a party anywhere they're at any time, and people flock to them. I think there's good balance in the middle. Don't ignore technical analysis. Don't underanalyze things. Make sure you are doing your due diligence when it comes to technical analysis. Be careful that you don't overanalyze things. It is a real danger in trading the markets and in trading the way we do to get in and overanalyze things. Okay? We talked about stockcharts.com. Finance.yahoo.com has some good information on it. These are just some places that I go for some various information. You can go back and pause your screen later if you want to look at that in more detail. Let me make some quick commentary about sentiment and earnings, and then know that we've got 2 classes coming up, one each that focuses on these 2 subjects. Never ever lose track of when the next earnings report is. Consider knowing when your earnings reports are coming up. Consider that part of your overall due diligence. Consider that part of your technical analysis. And always be aware of what other investors are thinking, and don't assume that fund managers or analysts think different than you do. One of the reasons we do a class on sentiment analysis, something that I've not seen, I'm not saying it doesn't exist there, but I've not seen it in any other investment education anywhere I've looked. An entire class devoted to sentiment analysis. The reason we do an entire class on sentiment analysis is because you've got to know what the groupthink is. You've got to know what the crowd mentality is, because a large enough group of independent investors can move the markets and move the direction a stock is going just as easily nowadays as a fund manager or a hedge fund manager can move it. It used to be that we always talked about you have to follow big money. You should, and I'm not saying that you don't still consider that, but we used to talk about how you've always got to follow big money, follow what the big money is doing, as if they were somehow way smarter than we were. We've got so much information at our fingertips. We've got so much data available to us, and so many different ways to learn how to interpret that data and what to do with that data, that we have the same information available to us now that used to only be available to fund managers and market analysts. They're not any smarter than we are. They just do it for a living. Don't fall into this trap that they know more than you. And don't lose track of what other investors are thinking, because they have the ability to drive the markets. This summary right here, I purposely did not change this summary page from the one that was in the previous class. No technical indicator is perfect. Educated guesses are still educated guesses. Don't allow yourself to be paralyzed with too much information. Make a decision based on the best due diligence you have available to you, and then follow through and stick with that decision. And now we're going to start getting into more and more stuff on strategies and how to do different things. And we'll just keep pressing forward from here. That wraps up our class, everyone. Thank you for your questions and for your input. Have a great day. Bye-bye.